Hey everyone, welcome back. I'm Eric. So let me ask you, what's the one book that a legend like Warren Buffett found so important he actually read it twice? Well, we're about to find out. Today, we're diving deep into the mind of a master, Howard Marks, and his incredible book, The Most Important Thing.
But first, a quick question for you. Be honest, have you ever felt that frantic energy when the market's on fire? Everyone's making a killing, and you get that voice in your head screaming, if I don't get in now, I am going to miss out. So you jump in, only to find out you bought right at the very top. Or maybe you've been on the other side. The market's crashing, panic is everywhere, and all you can think is, I've got to sell, I have to get out now before it all goes to zero. And then you watch it bounce back the next week.
You know, if any of that sounds familiar, you are definitely not alone. This is the classic emotional pendulum that gets the best of us, swinging wildly between greed and fear. And it almost always leads to the worst possible strategy, buying high and selling low. So, how did the true masters of the game avoid this trap? Do they have some kind of crystal ball?
No, of course not. What the best investors have isn't a magic ability to predict the future. It's something way more powerful and a lot more reliable. It's a superior thinking framework. It's like a mental operating system that lets them see the market with total clarity while everyone else is lost in the chaos.
And the guy who literally wrote the book on this way of thinking is Howard Marks, the co-founder of Oaktree Capital. His book, The Most Important Thing, is basically the Bible for serious investors. And yeah, it got the ultimate stamp of approval from the man himself, Warren Buffett.
So in this explainer, we're going to upgrade our own mental models. We're going to break down Mark's entire philosophy into 3 powerful ideas you can start using right away. First, mastering second-level thinking. Second, completely redefining investment risk. And third, learning how to be a smart, contrarian investor. You ready? Let's get into it.
Okay, Part 1, Mastering Second-Level Thinking. Pay close attention here, because this is the absolute foundation for getting better than average results. Honestly, this one idea changes everything.
So what on earth is second-level thinking? Well, it's about training your brain to go one layer deeper than everybody else. While most people see a piece of news and just react, the second-level thinker stops and asks a simple but powerful question. And then what? It's about seeing the ripple effects, the consequences that others completely miss.
Let's break it down. First-level thinking is simple. It's superficial. It sounds like, hey, this is a great company. The product is awesome. Let's buy the stock. That's what 99% of people do, and it's why they get average results. But a second-level thinker goes further. They say, okay, yes, it's a great company. But does everyone else already think that? Is all that excitement and optimism already baked into the stock price? What happens if they don't hit those incredibly high expectations? See the difference?
And this leads to a huge insight. The market isn't moved by good news or bad news. It's moved by the gap between what was expected and what actually happens. So let's say Wall Street expects a company to earn $2 a share, but they end up earning $1.90. Now that's still a ton of profit, right? But because it missed the expectation, the stock price can absolutely get crushed. That's the power of the expectation gap.
All right, let's move on to Part 2, Redefining Investment Risk. I'm going to challenge what you probably learned in business school, because what most people think of as risk really isn't.
You know, ask any finance professor, and they'll tell you risk is volatility, how much a price bounces around. But Howard Marks says that's just wrong. Think about it. A stock can be super volatile, it can drop 50% and then shoot right back up to where you bought it. Yeah, it was a crazy ride, but you didn't actually lose any money. Is that really risk?
No? According to Marx, the real risk, the only one that truly matters, is the chance of losing your money for good. It's not about the turbulence you feel during the flight, it's about whether the plane lands safely or not. A stock that just slowly bleeds out and goes to zero might have very low volatility, but it's infinitely riskier because your capital is gone, permanently.
So if that's the real risk, where does it come from? Well, it comes from one main thing: paying too high a price for an asset. This quote from Marx says it all. You could find the greatest company in the entire world, but if you overpay for its stock, it can still be a terrible investment. The real art isn't just finding quality stuff, it's about buying that stuff for way less than it's actually worth.
So how do we protect ourselves from paying too much? We use what's called a margin of safety. And this bridge analogy makes it crystal clear. You wouldn't build a bridge that can hold exactly 10,000 tons if you expect 10,000-ton trucks to drive over it, right? No way. You build it to handle 15,000 tons. That extra 5,000 tons of capacity, that's your margin of safety. It's the same in investing. If your analysis says a stock is worth $100, you don't buy it at 99. You wait.
You wait until you can buy it for 60 or 70. That big discount is your buffer, it's your protection against being wrong, bad luck, or just the unpredictable future.
Which brings us to part 3, smart contrarian investing. Okay, so now we know how to think on a deeper level and what true risk really is. Let's put it all together and learn how to use the market's craziness to our advantage.
Marx has 2 beautifully simple rules about this. Rule number 1, most things in life are cyclical. Markets, economies, public opinion, they go up and they come down. Nothing moves in a perfectly straight line forever. And rule number 2 is the kicker. The absolute best opportunities to make money show up when most people forget all about rule number 1.
Why? Because these cycles are fueled by that emotional pendulum we talked about. At one extreme, you have peak greed. Everybody's euphoric. They're all saying, this time it's different, and they're willing to pay insane prices for assets. At the other extreme, you have peak fear. It feels like the world is ending, and people are panic selling everything they own. No matter how cheap it gets, everything is on sale.
A smart contrarian doesn't just do the opposite of the crowd for the sake of it. No, it's a very logical process. First, you have to get a feel for the market's temperature. Is everyone terrified or are they greedy? Then you act against that extreme emotion. When fear is through the roof, that's when prices are in the basement and your margin of safety is huge. That's your time to buy. And when greed is off the charts, that's when prices are sky high, your margin of safety is gone, and that's your cue to be careful, maybe sell a little, or just sit on your hands and do nothing at all.
So let's just tie this all together. Here are your key takeaways. Number 1, think deeper. We have to master second-level thinking to see the opportunities and risks that others don't. Number 2, redefine risk. Forget volatility. Focus on avoiding permanent loss by always demanding a margin of safety. And 3, be a smart contrarian. Use the cycles created by human emotion as your greatest source of opportunity. You see, these 3 pillars all work together to create one solid, powerful philosophy for success.
And here's the really amazing thing. This way of thinking goes so far beyond just the stock market. I mean, think about your career. Are you jumping into a hot new field just because everyone else is, where the expectations are already through the roof? Or are you finding an undervalued niche where you can really shine? This is a toolkit for making better decisions in every part of your life.
So I'll leave you with this one question to think about. Tomorrow, when you're looking at the market or reading the news, don't just have that first-level reaction. Stop for a second and ask yourself, what are the real expectations here? Where's my margin of safety? And where are we right now on that emotional pendulum?
If this breakdown helped upgrade your thinking even a little bit, do me a favor and hit that like button, subscribe, and maybe share this with a friend who'd find it useful. And hey, we really want to hear from you. Is there a book or a big idea you want us to tackle next? Drop it in the comments below.
Thanks so much for your time and for thinking along with me today. I'm Eric, and I'll see you in the next one.